Hey everyone, hopefully having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there. Let's take a look, see what's going on, and I'll share my opinions. If you want to follow me, it's at Finance. And if you want to join our community, finding-value.com, where I dive deeper into all of these sectors and topics, looking for potential investment opportunities and talking about the macro and the yield curve, recession possibilities, all of those things. So Farah, I don't know where this person is located, but their electricity bill was $741. I'm guessing that's per a month. What was yours? Mine was approximately one-tenth of that, $74. I had to go look it up. My entire utility bill for the month, for the prior month, it was either July or August. I can't remember which bill I was looking at, but the bill in July, I believe, was $150 total. So my entire utility bill was $150. And I do not use air conditioning. Yes, there's a couple of hot days, but for the most part, it cools off, and I'm just fine without using air conditioning. Josh Young, when the time comes to buy, you won't want to, Walter Deemer. And this is what we're experiencing, a big pullback. So when it is time to buy, a lot of people are going to be scared. They're going to be fearful. So those are the shares that you have to commandeer from those other people, is when they are fearful and the price is cheap. It's how you make all the money. Just like Warren Buffett says, be greedy when others are fearful. Kobayashi letter just in. U.S. manufacturing has officially contracted for the fifth consecutive month to 47.2 points. The ISM manufacturing PMI index missed expectations of 47.5 points for last month. New orders fell to 44.6 points from 47.4 in July, experiencing contraction for the third straight month. Manufacturing activity has now shrunk in 21 of the last 22 months, extending the second longest downturn in history. The worst part, the prices paid index jumped to 54 points from 52.9 in July, expanding for the eighth month in a row. Rising prices with falling output is a recipe for stagflation, which we're in. And here is the ISM manufacturing index with contributions, and you can see that we are negative here and contracting. We saw contraction in 2000, 2001. I do think that this is very similar time frame to what we're experiencing today. I don't think we're going to have a big housing market crash like 2007 and 8. I think it's going to be very similar to 2000, 2001. So that's kind of what I'm modeling, and maybe this is a double bottom that we're going to get here over this next few months or 6 months or something like that. Coming back. Gary Savage, he says, selling is intense in everything today, including the metals. That probably means a temporary bounce. Resist the urge to buy that bounce, as this still has further to drop before it's time to start buying aggressively. We need dumb money to start to panic sell. That's when the rest of us will need to be buying hand over fist. This pullback will set the stage and create the fuel for a move to at least 2,700, maybe 2,800 by year end, and 3,000 to 4,000 by next year. My best guess for him is the buy signal will trigger early to mid next week. Be patient and don't panic in the meantime. This will look scary. It already does if you're holding mining stocks, but it will be temporary and quickly recovered once the bottom is struck, in his opinion. So Gary thinks maybe early to mid next week, we could get a buy signal, and that this is just temporary pullback and could be one of the last pullbacks before we really launch to much higher prices. I would agree with that. It very well could be the case. I'm in the camp that's kind of indifferent. I'm in this stuff for the longer term, And with the yield curve uninverting, I just buy stuff and hold. It's not. I don't play the short term market noise. When things get cheap, yeah, of course I'll buy, but I don't really ever panic. I just buy and I hold on, and I wouldn't even panic if I was in oil, which I am. I don't panic, so I've got a good chunk in precious metals, which offsets the oil. And I think with the yield curve uninverting, yeah, we could see everything sell off during periods. But overall, I think gold and silver will do well, and that's a big portion of my allocation. So should be pretty good. It's in gold we trust. He says, no, this bull run is not over. So we had this big consolidation from 2020 into 2024. We've broken out of that consolidation, and he's got a $4,800 price target out in the future there. Warren's opinion here, he says the oil sell-off is much more of a Chinese growth issue and OPEC reality hitting. Don't fall into the trap of assuming oil is telling you much about the U.S. economy, elections, etc. So he's saying that don't look into oil for the U.S. It's more about Chinese growth and then the reality of OPEC potentially adding barrels out in the future. Coming down, we've got HFI Research. He says our crude storage estimate for this week's report, they've got a big draw of 6 million barrels. So we'll see if that occurs. That big draw in oil is their estimate. Avi says, meanwhile, the Baltic Dry Index is inflecting higher again, much like it did during the initial wave of inflation following the COVID-19 lockdowns. For those who may not know, this index reflects the average cost of transporting dry bulk goods, including coal, iron ore, and grains across over 20 global shipping routes. This increase also aligns with today's stronger than expected prices paid in the ISM Manufacturing Index. So is this a second wave of inflation that's already underway when using the Baltic Dry Index as an example here? And what I see, you could draw a trend line across here, and you can see a breakout and then a retest. And then maybe we're coming from that base there. Very well could be. Here's Brett, says we are 15 days away from the first Fed rate cut of this cycle. Using the same time frame, I overlaid the following past rate cut cycles: 1981, 1990, 2000, and 2007. He says these four cutting cycles match the same data that we're seeing currently: the unemployment rate curving up and the 10 and 2 inversion. The sentiment from the bulls is that rate cuts are suitable for the market. This is true in the long run. History shows that market pumps, on average, for 25 days after the rate cuts, followed by an average of a 13-month sell-off. Could we get one last pump around the cuts? Will this time be different? Anyone who tells you what exactly will happen is lying. Be open-minded, look at all the data, and use your best judgment. So here's all of those previous, it's 81, 90, 2000, and 2007. The only thing I'll say that could be a little bit different, not saying it will be different, I'm just saying I think we're closer to 2000 here than we are in 1990, 81, and 2007. Those are all real estate slowdowns. 2000 wasn't a real estate slowdown. So I think that is the best one to compare to. I don't know which one 2000 is in this chart here, but you can tell they all went lower. But this one didn't go down that much, but the rest did. So we're probably going to go down lower in the S&P 500 and probably the NASDAQ too. And I think we're most closely matched to the year 2000, given we're in a tech bubble, and the real estate market, I don't think, is as weak as 2007 or 1990 or 1981. Those all had a demographic of home buying years dropping. We had an overbuilt situation and a bunch of supply. We don't have the supply right now and the demographic is still strong. So I don't think it's like these time frames. It's like 2000. $1 million in 2004 is the same as 1,660,000 in 2024. He says inflation could be the silent wealth killer. Invest, invest, invest. Well, I responded with gold average 2004 price was $410 an ounce. $1 million in gold was 2,439 ounces of gold. Gold is now $2,500 ish, or 6,097,500 if you had purchased it in 2004. Ratio swapping metals will even outperform this by a large margin without taking on huge risks. So, a big portion of my portfolio is subject to this, playing that ratio swapping game. And looking backwards, gold has outperformed since the year 2000 the S&P 500 and the Nasdaq. Well, the S&P 500. I don't know about the Nasdaq. I haven't looked at that one. The S&P 500 for sure. Liz Ann Saunders says September has historically been the worst performing month for the S&P 500 since 1928. It's finished higher only 43% of the time, with an average decline of 1.2%. So these are the average S&P 500 performance by month, and you can see September is by far the worst. And we are in the month of September. Hopefully this doesn't make you hate September. U.S. households now have 42% of their financial assets in stocks. That's the highest percentage on record, with data going back to 1952. And that's probably a combination of just the stock market being in a big bubble. So if it's in a bubble and people own those assets, of course it's going to be the highest allocation if the value of that asset continues to go up and is at record highs. So, I mean, that kind of makes sense to me. But will it stay up there? Yeah, I doubt it. Crickets and mayhem. Wow, private sector job growth is at recessionary levels, according to Bank of America. So much for the idea of a strong labor market. And this is the private sector is at recessionary levels at 38%. 40% equals a recession for the majority of these times. Freight futures looks like dry bulk down 1%. Panamax is flat. Tankers are down 2%, 1% for shipping. Eric Nuttall says oil price hitting its lowest level year to date while global oil inventories hit their lowest levels. As far back as Kepler data set goes, it's amazing. So here it is where they've got for global observable oil inventories, and we're at very low prices here. We're hitting the lowest level year to date. Manish Pabri, and I like what he said here. He said, virtually every week I have several hours of golf, duplicate bridge, reading, etc. I do not need to go on vacation for these activities. In fact, these activities become harder when I travel. No shortage of friends either. Work has always been more fun than fun. I'm on vacation 365 days a year. I do not need to go on vacation. Going on vacation has very little appeal. That's the life that I am trying to set up. I want to live in an area that I enjoy. I want to do things that I can do every single day that I really, really like. And I want to not need to go to a vacation to escape the life that you're setting up wherever you're setting that up. So I like what he said here. He doesn't need to do that crap. And, I also agree with that. I'm not a huge traveler. I don't really like it. The reason I don't like traveling all that much is you got to pack up, you got to go drive, go in a car, go drive to the airport, sit in an airport for a few hours at least, get on an airplane with a whole bunch of random people, potentially increasing your chances of getting sick and all that stuff. Then you fly a few hours or however long, which costs money, go to an area, and then you have to unpack and do all this other stuff. Yeah, vacationing is okay every once in a while, but I don't know. I want to set up a life where I can literally just do whatever I want, wake up, and have it be convenient and easy. That's kind of what I envision my life being. And I think it's pretty close to what Manish has here, what he posted. Here's Tin. He says, history may not repeat, but it sure does rhyme. Anyone who studied the 1970s knows the general stock market was a dead zone for a decade, while gold and silver miners produced life-changing upside, entering now the greatest metals bull in 2 generations. So I think we're entering a similar period. We may not have entered, like we're probably entering just the beginning of it. So think of it as like we're probably in like the 1960s. I know that they have this coming up and down, but it doesn't seem like that's where we're positioned. I see a lot of physical tightness in commodities in terms of supply demand deficits out in the future. And then I also see precious metals doing very well with this yield curve uninversion and all that stuff. So it seems like we're really early in this. And back in the 1970s, there was 2 big pullbacks. Gold went up during the pullbacks in the real estate market. It went sideways and consolidated when we got those inflationary impulse moves. So it's behaving the exact same way as the 1970s did. It didn't go up because of inflation necessarily. It went up in the slowdowns between the market moves. So early 70s, and then the slowdown that occurred in the mid 70s, and then the blow off at the end. This is Kevin. He says the threat on asset bubbles, inflation, AI hyperscalers, and the potential hidden secrets of the CapEx cycle. I'm not going to go through all of that, but just large cap growth, price to book, it's basically in a mega bubble. We can just I'm just going to hit on some of the NVIDIA price to book in a big bubble, way up there. We've got Apple price to book in a bubble, is what we're seeing here. CapEx cycle, inflation adjusted, tech and communication services and Amazon, way up there. Very similar to bubble territory. The AI hyperscalers of 2024, the trailing 12-month CapEx with market cap, way up there, all-time high. The internet hyperscalers of Y2K, trailing 12-month CapEx with market cap, you can see the big bubble and then the turn down. So we could be looking for a potential turn lower in this. Here's top vendors to the Y2K internet hyperscalers market cap: Cisco Systems, Sun Microsystems, and Lucent Technologies. But these guys didn't really have much earnings. NVIDIA does have good earnings. I will say that. Gold miners versus the CapEx cycle, it's starting to break to the upside. That's looking fantastic. This is where I think the rotation is coming. We're rotating from technology into precious metals and commodities. So that's bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. John Templeton. Inflation expectations higher. We're seeing a divergence here, but University of Michigan survey is definitely higher. The commodity sometimes begins simultaneously with large cap growth in technology stocks busts. So you can see the big valuation gap and difference between financial energy materials and tech, telecom, and healthcare. And this is the peak that it also occurred. You can see when these diverge, that's going to be your ratio going cheap for financials, energy, and materials. We're at that same cheap level, 24%, 25%, 44, 44, 44. And that went up. Financials, energy, and materials went to 44% in 2008. So we're going to look for a 44% uptick when this moves lower and this moves higher. That's what we're seeing here going forward. And that's what we've got from there. Jordan says, 2 very important insights with respect to gold in a 60-40 portfolio. Gold diverges from stock market bears around the start of a secular bull, as evidenced by a breakout in gold versus the 60-40. At present, we won't get a breakout in gold versus 60-40 signal until the next bear market in the S&P, which actually could happen in a second. Hence, gold and precious metals will rise during the next S&P bear. The 2008 boogeyman everyone is afraid of does not come for gold until midpoint of a secular bull. 75, 76 in 2008 were around a slightly after midpoint. There's the midpoint. Boom, pullback, boom. And we're ready to break here at any second for gold versus the 60-40. You can see that we're basing out. Katusa says it costs on average $75,414 to mine a Bitcoin now. The price of Bitcoin is $58,460. Mining is much more expensive and seeing its widest nominal gap in its history. And I'm curious to see how this works here because I think the fees are going to go massively higher for the transactions in Bitcoin. And I want to see how that impacts the people who own Bitcoin. And this could diverge massively. Like Bitcoin could have this huge mining cost, and then the price goes way lower. And I'm curious to see what the fees look like. Jordan again, he says inflation adjusted gold price closed at the third highest monthly close ever. Why is this important? Inflation adjusted gold price is fundamental indicator for gold stocks. And here we are breaking to the upside. Looks really, really good. And we can see a big move in the miners. And that's what we've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And we'll catch you guys next time. This is Finding Value.